system. And within the financial system, we have traditional investments and we have alternative investments. Now, all of these are going to be discussed in different areas of your CFA curriculum, right? Such as, for example, traditional investments includes cash, stocks, bonds. Alternative investments includes commodities, real assets like real estate, and you've got different type of strategies using these stocks and bonds that hedge funds do or private equity funds do. So let's say private capital, right, which includes private equity and private debt. And if you don't know what is the concept of equity and debt, a company when it starts to do business takes a loan, right? That's debt. The original investment of the shareholders is called equity, and they invest in some certain assets which then help the company earn some money, through which they pay interest to the debt providers, and then they share their profits with the providers of equity. Now, these are all different types of assets, right? Cash is a asset class, stocks are assets, bonds are assets, even private capital, which includes if a bank is giving this loan to this company privately, not through the public markets, then it is an asset. If somebody is investing in a company but not through public stocks but privately, that is called private equity. So within private capital, you will have private equity, you will have private debt, right? But if this equity is on the stock market, if they do an IPO and they sell these stocks on the stock market, that becomes a traditional investment, which is your stocks. Of course, real estate is another asset, and hedge funds, investment in hedge funds, of course, will be considered an asset, and they do all sorts of complicated strategies, which we talk about in alternative investments. So within your CFA curriculum, you have a section on alternative investments in which we get into a lot more detail about private capital and real assets and hedge funds. You have a section on equity, which you are in right now, which of course is going to cover your discussion about stocks. You have a section of fixed income, which in detail talks about bonds, right? Fixed income is going to talk in detail about bonds. And then you can also have contracts based on all these different assets. Right, so for example, you might have a contract to buy a stock, not right now, but after a year. So you might be getting into a future contract or a forward contract where you lock the price today, but you make the payment after a year and you get the stock after a year. And similarly, you could have a contract for a bond as well. You could have a contract for any asset, right? So if you have contracts for these assets, then you are coming into the world of derivatives, which is of course another section in your CFA curriculum. So in this reading, we're going to look at a high level overview of the entire financial system and what purpose it serves, right? What are the 6+2 benefits we get from it, or the functions that it achieves for us. So that's important. From an exam perspective, you might get a question on what those functions are, and we'll shortly just get into it. But let me just help you develop a mental map before we start going into the details a little bit. So we're going to talk about what the entire financial system is, what does it achieve for us, what's the difference between assets and contracts based on those assets, or contracts that derive their value from those underlying assets, which are called derivatives. Right? And all of these together are called securities. So if you're buying a stock or a derivative contract based on that stock, they are both examples of securities, right? So all of this is securities. Then we will get into a little bit more discussion about currencies, commodities, and real assets, which of course is going to be more within the alternative investment space. And then of course you will get into a lot more detail about those when you actually start studying your alternative investment sections. When you talk about contracts, that's of course going to be about derivatives. Here we're just going to have an introductory discussion about contracts, a lot more detail in your actual derivatives section. Now moving to the concept of financial intermediaries. Now what does that mean? So let's say an individual deposits cash in a bank, right? And then that bank then takes that money, might be giving a loan to a company, so let's say that's private debt, but that bank might also be investing into some government bonds, right? And they might even be investing into some stocks, right? So this individual who's putting cash into the bank might not have the sophistication to give loans or buy bonds or stocks themselves. They might be just a simple retail deposit holder of a bank. So what the bank is really doing is basically bridging this gap between these two parts of the financial system, and that's why we call the bank a financial intermediary. There are other players as well, such as securitizers, and we'll talk about what that is when we get to that point. Depository institutions and insurance companies. We'll talk about settlement and custody providers. And then you might have some individuals who are directly capable of buying bonds and stocks, and some in funds that are directly capable of doing that as well. And we'll talk about, okay, how do they take positions? What are the different positions they can take in terms of long versus short? And hedge funds especially might actually use a loan to buy a much bigger position than they have cash for, right? So that's a leverage position, and then we'll talk about how that impacts the return and how do you calculate. There's a calculation over here, so that's important again from an exam perspective. So far as this reading is concerned, we've talked about two things which are probably testable. More probability is there that you might get a question on this leverage calculation. You might get a question on the functions of the financial system. Everything else is, of course, discussed in a lot more detail in other parts of the curriculum. We're going to have an interesting discussion on orders and execution instructions. Really interesting practical stuff here in terms of, what are the different types of orders when you really execute them in the market, right? So where the rubber meets the road, what is the type of order you should place to your broker when you're buying or selling an asset? And what instructions go with that order, that how long it should stay valid, right? Where should your stock be given back to you? Are you going to keep that at the broker, or you're going to put it in some custody provider? Then we'll talk about the difference in primary and secondary market. So let me just give you a high level overview on what that is. And the reason why I'm spending so much time on the contents over here is because this is a very big reading. It basically covers everything under the sun when it comes to the financial system. And if I don't give you a high level overview right now, you might get confused when we jump into the actual point. So that's why I'm giving you a sort of a big mental map right at the start, and then we'll slowly get into everything. So the difference between primary and secondary markets. So let's say there is a company, right, which is a private company, right? It started off by taking a loan from a bank, which is debt, right? That's private debt. And it started off by taking investment from its shareholders, which is equity. And why private? Because obviously it's not traded in the public market. Later it goes to the stock market and does an IPO and sells stocks in the stock market, and that then becomes public. Now when that's happening, whoever is the investor that buys the stock in the stock market for the first time, that is known as a private market transaction, because it's the first time that somebody is buying the stock in the public market and this company is getting money. But then later on, when that investor sells the stock to another investor and gets money from them, right, then that becomes a secondary market transaction. And of course, derivatives also have trades going on between investors. So we'll talk about how those contract markets work. Then finally, we'll close off with what are the characteristics of well-functioning financial systems, and finally, what is the role of market regulation within all of this. So as we said, this is going to cover the functions of the financial system. What are the different types of assets that are used within the financial system? Financial analysts obviously analyze them and give recommendations on them. What is the role of a financial intermediary, like a bank that might be taking cash deposits on one side and investing in stocks and bonds and giving loans on the other side, right? What is the difference between a long and a short position? What are the different types of orders that you can place when you're buying and selling these assets? Who are the different market participants? What is the difference between the primary and secondary markets? And finally, we'll close with the characteristics of a well-functioning financial system. Right. So starting off with the functions of the financial system, and this is 6 plus 2, right? First, we're going to talk about 6 systems and then 2 additional benefits that we get from the financial system, and this is important. So you really need to remember these. So the financial system includes markets and financial intermediaries. What does that mean? That means obviously it is a combination of 2 things. Number one, the players that are there, the intermediaries such as banks, and then their depositors and their borrowers, etc. So all the people and the players that are involved, and when they come together, they make the market. And of course, a market is a very interesting place, because then when you're buying and selling in the market, it helps you discover the prices at which people are willing to transfer those assets, whether they are financial assets such as stocks and bonds, or real assets such as property and commodities. So what price they are exchanging at, that is the price discovery process, right? They might be using derivative contracts to manage risk between them. So for example, let's say Emirates is an airline and it needs to buy oil to put in their planes, of course, and they might be selling tickets for next year, right, from now, because people like to book their vacations in advance. So it doesn't know what the oil price will be next year, but what it could do is it could get into a future contract or a forward contract. And again, we'll talk about what is the difference between future versus forward contracts shortly, but it could get into a contract to actually lock the price from now, right? So from one point to another, and manage their risk, so that regardless of where the oil price goes in the future, they don't need to worry about it, because they lock the price now and they can sell the tickets for next year from now. So we'll talk a little bit more about all these things as we go along. But first, you need to focus on the 6 points that are mentioned over here, which is the functions of the financial system. Number one, of course, we are bridging the saving surplus unit with the saving deficit unit. Now, what does that mean? There might be an individual, or there might be a company that, or an organization that has more money than they need. So this is a surplus unit. There might be an individual or a company or an organization that needs money to grow, so they are having a saving deficit situation or a saving deficit unit, and the financial system obviously helps bridge them, right? So somebody might want to save, somebody might want to borrow, right? So how do you link them together? Well, that's where the financial system comes in, right? And you could have a financial intermediary such as a bank helping them do that. So that's, of course, the 2 core things that are going on. Of course, if a company doesn't want to borrow, they can either take a loan, right, which is debt, but they could also sell their ownership stake and get investment from saving surplus units as equity. So they could raise equity. So the savers could not only put their money in debt investments, but they could also put their money in equity investments. The financial system also consists of derivative contracts based on these assets. So, and you could use those derivative contracts to manage your risk, right? You can even get into future deliveries. So the spot market is for deliveries right now, but the future markets are there for future deliveries. And of course, let's not forget, a lot of people use the financial system for speculating, so you can trade on information as well. Plus, of course, we talked about 6 plus 2. So this first one is the 6, right? So the 6 functions that we just talked about help the people achieve the purposes that we said, plus these additional 2. Now, what are those additional 2? When you are having a market of money, in a way you can say, right? There's somebody who has more money than they need, there's somebody who has less money than they need, and they're coming together, and the lender and the borrower are kind of figuring out, okay, what's the rate of return you're going to give to me, and what's the rate of return I'm willing to take. And then when they agree on that, the aggregate saving and the aggregate borrowing together come and get into an equilibrium. That's where we find out, okay, that's the price of money right now, right? So it really helps us understand what's going on in the overall economy, especially when it comes to money supply and money demand. And then, of course, it's much more complicated than that, and we'll talk a lot more about it in economics. But the second thing that this financial system helps us achieve is allocating capital to the best users. Because, I mean, let me just go back to the previous slide. So when you save in the bank, of course, is going to be very careful in terms of who they are giving a loan to, right? And whether that's an individual or a company, and the best companies and the best individuals are more likely to get loans than others. So the capital automatically gets allocated for the best users. And it's not just the banks, and whoever is coming to take money or borrow money or get equity investments, they have to fight for it, and the best one will have the highest chance of getting that. So the financial system actually really helps us achieve that allocation to the best use part as well. Now, moving on, we already talked about the different types of assets, and then of course you can have contracts based on those assets that derive their value from those assets. So let's now talk about the different classification criteria that we can have for these assets and contracts. First of all, of course, you can break it up into financial assets versus real assets. Now, financial assets are like stocks and bonds, whereas real assets are like real estate, commodities, etc. Right? Now, within your stocks and bonds, of course, you can think about it in terms of debt and equity. So bonds are debt and stocks are equity, right? And like I was telling you, that stocks in a private company or a loan to a private company is a private capital, which is of course consisting of private equity and private debt. So whether it is equity or debt, they can be private, and both equity and debt can be public. So public equity will be called stocks and public debt will be called bonds. You can have trading in the spot market. So if you're buying and selling right now, and by the way, a delay of 2 days and 3 days is not the future or forward market. That is still considered spot. I mean, when you're talking about future delivery, that's not 2 days in the future. It's like a month at least or more than that, right? Because usually our spot markets are working at T+2, which means it takes on average 2 days for the asset to be delivered into our account once we make the payment. Right, what else? You could have contracts, and they can be classified across financial derivative contract versus physical derivative contract. So if the contract is for, let's say I want to buy a stock, but I'm going to pay after a year and I'll get the stock after a year, well, that's an example of a financial derivative contract. Or if I want a bond, but again at a future date, and the payment will be in future, so that again is an example of a financial derivative contract. On the other hand, if I want to do the same thing for a commodity like oil, like Emirates is doing in our example, well, then that becomes a physical offer, that becomes a derivative contract of a physical asset, so hence it is called a physical derivative contract. We already talked about classifying this on the basis of primary and secondary. So primary is where the securities are sold for the first time to the investor, and the company issuing the security is getting the money. And then when investors buy and sell the securities among themselves, that is called a secondary market transaction. Now, when it comes to your maturity, right? If you are getting your money back, so the investor is getting their money back with interest within a year, that's called money market. But if it is more than 1 year, such as bonds, that's of course going to be capital market. So bonds are capital market. Stocks obviously are definitely going to be capital market because they don't really have any maturity, right? Your money market, on the other hand, has things like T-bills. So the government issues T-bills which give you your money back within a year. Corporations issue something called commercial paper, which also give you your money back within a year. Right. Traditional investments include stocks and bonds, publicly traded debt, which is bonds, and publicly traded equity, which is stocks. Alternative includes, of course, your private capital, which includes private equity, private debt. It also includes various different combinations of these public stocks and bonds, which hedge funds do. So not only just long only traditional stocks and bonds, but if you do long and short, and what short is, if you don't know, don't worry, we're about to discuss that in this chapter, in this learning module, that what short is. But hedge funds take both long and short positions, which makes them alternative. Commodities like oil, gold, etc. are considered alternative. Real estate is also considered alternative, and there is a whole section on that within your CFA level 1 curriculum. Right, now moving into securities, of course you have your bonds and treasury bills, etc., which is fixed income because they pay a fixed contractual interest. So T-bills are money market because well, they pay you your money back within 1 year. Bonds would be capital market because they pay your interest and your principal back more than 1 year, they take more than 1 year to pay your principal back. So those are your fixed income securities because they are debt in nature, which means their interest or income is contractually fixed. Stocks, on the other hand, or equities on the other hand, are not fixed income, right? And we'll talk a lot more about those. And then of course you could have a combination of investments in a pool. So investors could all together put their money in a pool, right? And then that pool could then go and buy these securities, whether they are stocks or bonds or T-bills. And why do we like to do that? Because you might have a fund manager who's managing the pool, and individually these investors might not be that capable, and the fund manager could then manage for everybody. And also when you pool your money together, you might be able to get a diversified portfolio, which you might not be able to achieve on your own because your investment size might be small compared to when you pool it together, right? So we'll talk about all the different types of pooled investment vehicles that we have available. So starting with fixed income. Fixed income is, of course, having a obligation to pay the interest, right? And it's fixed. As per a predetermined schedule, hence the name fixed income. They might be collateralized. So what that means is you can have secured bonds, right? Some bonds are secured, some bonds are unsecured. So secured bonds means that, okay, they're supposed to pay you an interest and your principal back as per a predetermined schedule, but if they don't pay it, there is some asset within that which is providing you a certain security as collateral. So in case if the bond is not able to pay back, you can try and take care of that. You can take control of that asset, that collateral, which will be a certain physical asset, and try to sell it off and get your money back, right? So the investors have a claim on those certain physical assets in case of default. And usually there's a trust involved between the bondholders and the issuer. A trust is an institution that, of course, represents the interest of all the different bondholders. Now, within fixed income, of course, you have your long-term bonds, which is greater than 10 years maturity, right? If you have between 1 and greater than 1 but less than 10, so that's where you have your notes. And then less than 1 year, of course, would be your treasury bills from the government's perspective, and commercial paper from the corporation's perspective. Of course, within private debt, right, you have bank borrowings where the bank gives a loan to your companies. So a lot of different names we have of those loans. There can be an overdraft, there can be a credit line that could be committed, it could be uncommitted, it could be revolving. That means you use however much you need, you pay down the rest, or you have like a predetermined schedule of borrowing and giving it back. So of course more on banks later within fixed income. And debt can be exchanged for equity as well. So as a company, somebody might take a loan, and then later if the company starts doing really well, the party which is giving the loan might say, okay, can you convert this into stocks since you're doing so well? So that can be there as well. Bonds can be convertible as well, and a lot more on that in the fixed income section. Equities, this is the equity section that you're in. So of course we're going to talk a lot more about equities over here. And here equity is basically an ownership claim into the company. So when a business is there, of course it can take a loan from the bank or even from bondholders by selling bonds. So that could be again public and private both, right? It could be public and it could be private, right? Similarly, the company could get capital from equity providers, which again could be public and private. Right, so if it's a private company, then there's no stocks on the stock exchange. But if they sell the stocks on the stock exchange, well, then that becomes public, right? Similarly, if they're getting a loan from a bank, that's private, and if they're getting it, if they're selling bonds, then that's public. And within equity, by the way, you have common equity and you have preferred equity. Now, what's the difference between these two? So the company, let's say, got a loan from a bank of 10 million. They have common equity of 10 million and they have preferred equity of 10 million, right? So what does that mean? It means if this 30 million becomes, let's say, 40, they have assets of 30 million which grow to 40. They do really good business and their assets grow. Now the debt stays the same, the preferred equity amount stays the same. It's the common equity guys who get this additional 10. right? So they are what we call the residual owners. Now, what does the word residual mean? It means what's left, the residue, right? So in case, for example, God forbid, it doesn't go up, the business is very bad, and it actually goes down to 20. So, of course, the debt is still the same. They still have that claim of 10. And then after debt, the preferred equity holders get their a share, which is 10. They get a preference over the common equity, and the common equity guys get nothing, right? So they get what's left basically, and that could be more if the assets go up, and it could be less. So your equity has different types. You have your common shareholders that get the residual claim, right? Once all the senior securities have been paid off. So what does that mean? Obviously, debt comes before equity. So all the debt has to be paid off. And then within equity, of course, your preferred shareholders get a preference on the common shareholders, so they have to be paid off, and that's in the case of liquidation, right? But what about in the case of let's say dividends? So first, let's say the company is getting some cash that will be used to pay the interest on the debt providers, and then within equity, first the preferred equity holders will get their fixed dividend, and then if there is something left, then the company might decide to give something as dividend to common equity holders, right? So their dividend is also fixed. It's scheduled. Now, it's not the same thing as contractual, such as your interest. So this fixed income is a contractual obligation, which is a higher sort of a commitment than the schedule, which is dividends, the fixed dividends of preferred shareholders. So again, interest and debt gets preference over preferred dividend and preferred shareholders altogether, and then of course the common shareholders come in at last. Now, what are warrants? Very, very interesting. Let's say the common equity share per share is $10 per share of a company, right? If you give me an option to buy it. Now, this is an option, which means I have a right to buy this, but I don't have an obligation. At, let's say, $20 a share. If this share price goes up to, let's say, 30, I will be very happy in terms of profit and loss, right? Because I am able to buy something which is, let's say, worth 30 for 20. So I make a profit of $10, right? So this is called an option, and a lot more detail about this when we get to derivatives, but this specific thing is called a call option because it gives me the right to buy. If I were getting the right to sell, it would be called a put option, but more on that later. For now, the party which is giving me this right, if it is some third party, then it's called a call option. But if the party which is giving me this right is the firm itself, the company itself, whose stock this is, then it's called a warrant. And why do firms do that, right? So think of employee stock option plans where you would want the company management to work really hard. The stock price might be $10 a share right now, but you want to motivate them so that they work really hard and do really good performance so that the stock in the market goes to 30 and you as the shareholders of the company make a lot of money. So to incentivize the management, what you will do is you will tell them, listen, hey, we will let you buy stocks of this company from us at $20, and then they work really hard and take the price to 30 because they want to make this profit of $10. So that's an employee stock option plan, and you're giving them an option to buy it at 20, but since the company is giving them this option, it is called a warrant. Right, in terms of pooled investment vehicles, so how can you invest in stocks and bonds? Well, you could do it yourself if you have enough funds and you can develop a diversified portfolio yourself. You could do that yourself, or you could put your money together with others in a pool, and then you could have a fund manager manage your portfolio for you, right? And that pool could be called a mutual fund, it could be called a trust, it could be called an exchange traded fund, and it could be a hedge fund as well. Now, what's the difference in all of those? We'll just talk about that shortly. But first, let's understand what's happening in the pool. So the pool is like, it's a shared ownership, right? So everybody puts in a little bit money, and then the pool goes and buys things, assets, securities, and then everybody owns a part of that pool. So that's basically what's going on over here, that they have shared ownership. So a lot of investors might pool their money together, and then you have a professional coming in to manage their money as per a specific strategy. Now, you'll have lots of different strategies that we will talk about in hedge funds within our alternative investment section. Even ETFs, you can find all sorts of ETFs these days. that offer you exposure to different strategies, and you can even find different trusts and mutual funds. Trusts are usually private for families or some other special purpose, but mutual funds are available to retail investors, exchange traded funds are available to retail investors, hedge funds are available mostly to more sophisticated high net worth individuals. And I'll just tell you about the difference between mutual funds and exchange traded funds. But before we do that, let me just re-emphasize on the point that the point of pulling your money together is that you can then engage that professional, right? So that everybody can engage the services of that professional together, so that not one person doesn't have to pay the cost of his or her services, right? You could share the cost of their services, and by pulling our money together, we could have a much bigger portfolio, which would then help us diversify the portfolio in a much better way. Now coming to the difference between mutual funds and exchange traded funds. So mutual funds are either open-ended or closed-ended. Now what's the problem? See, closed-ended, new investment is not possible, right? Because the fund is closed. So the fund manager would just get everybody to come together, make the pool, make the investment, and that's it. New investment is not possible. However, intraday trading is possible, right? That's possible because the units of the fund are then trading on the stock market, and investors can trade and buy and sell among themselves during the day. Now that's good, but the new investment not being possible is a bad thing. On the other hand, the advantage with the open-ended fund is that new investment is possible, so that's good because it's open-ended, but intraday is not possible. You have to deal with the fund manager end of day only. So intraday trading is not possible, so that's bad, right? Now that's where ETFs come in, because ETFs allow you not only to have an open-ended, which means you can increase the investment whenever you want and decrease the investment whenever you want, plus you can do it during the day. So the ETF sponsor and the liquidity provider with them will dynamically either issue new units for you if you want to buy units, or maybe even redeem and cancel and give you the cash for your units if you want to sell them during the day. So that of course is a very, very good innovation that we've had in the financial markets, and more we are seeing that ETFs are actually replacing mutual funds as far as pooled investments are concerned. Alright guys, I think you need to take a break, get fresh, come back, and then we will jump into currencies, commodities, and real assets.